the real estate strategy that built generational wealth. Imagine two families. Both earn the same income. Both work hard. Both save money. Fast forward 40 years. One family is still living paycheck to paycheck. The other owns millions of dollars in real estate. Their children inherit homes, rental income, land, financial freedom. So, what happened? Was one family simply luckier? Did they have richer parents? Or did they understand one simple strategy that most people ignore? Because throughout history, the world's richest families have shared one obsession. Not stocks, not crypto, not luxury cars, real estate. From the Rockefellers to the British royal family, to modern billionaires like Donald Bren and Sam Zell, generational wealth has almost always been built on one thing: owning assets that continue producing income long after you're gone. But here's the twist. The strategy isn't just buying property. It's understanding why real estate creates wealth in ways that almost no other investment can. And once you see it, you'll never look at houses the same way again. Level 1, why wealth loves land. Thousands of years ago, gold was valuable, silver was valuable, but land was power. Kings fought wars over it. Empires expanded because of it. Families protected it for generations. Why? Because nobody can manufacture more land. Every city, every farm, every beach, every business district exists on a limited amount of earth. That's scarcity. And scarcity creates value. Think about Manhattan. In the early 1800s, much of it was farmland. Today, some buildings sell for billions, not because the concrete is special, because of the land underneath. The building gets older. The land becomes more valuable. This is the first lesson. The wealthy don't simply buy buildings, they buy locations. And locations become more valuable as populations grow, cities expand, businesses move in, infrastructure improves, demand rises. The land quietly becomes worth more, without doing any extra work. That's a powerful concept. But appreciation is only the beginning, because the real magic starts when the asset begins paying you every month. Level 2, the cash flow machine. Imagine owning a machine. Every month, it deposits money into your bank account, whether you're sleeping, traveling, or spending time with family. That's what rental property can become. A cash flow machine. One apartment, one duplex, one office building, one warehouse. Every tenant pays rent. Part of that rent covers expenses. What's left becomes income. Now compare that with a salary. Miss work. Income stops. Lose your job. Income disappears. But rental income follows different rules. Your property keeps working, even when you don't. This is why so many wealthy families focus on buying income-producing assets instead of expensive liabilities. Take apartment buildings. A landlord with 50 units doesn't depend on one paycheck. They receive income from dozens of tenants. Diversification happens automatically. If one tenant leaves, 49 are still paying. Now imagine repeating this process over decades. One property becomes 2, 2 become 5, 5 become 20. Cash flow grows, debt shrinks, equity rises. Eventually, the properties begin paying for themselves, then they begin paying for your lifestyle. This is where many people stop thinking, but the truly wealthy are just getting started, because they discovered a financial advantage hiding inside the tax code. Level 3, the game the wealthy play. Here's something that surprises many people. Sometimes, real estate investors legally pay less tax than high-income professionals earning the same amount. How? Because governments often encourage investment in housing, commercial property, and development through tax rules. One major advantage is depreciation. Imagine buying an apartment building. Its market value might increase over time. Yet for tax purposes, parts of the building may be treated as wearing out over many years. That accounting deduction can reduce taxable income even if the property's value is actually rising. Another advantage? Interest on investment loans is often deductible in many jurisdictions, subject to local tax laws. Then there's the power of business expenses: maintenance, property management, repairs, insurance. Certain costs may reduce taxable income. The result? Two people earn similar cash. One pays taxes as an employee, the other earns through appreciating assets while using legal deductions available to investors. This isn't cheating, it's understanding the rules. And wealthy families spend years learning those rules. Because every dollar saved can become another investment, another property, another stream of income. But the biggest secret isn't taxes. It's leverage, the force that allows ordinary money to control extraordinary assets. Level 4. The power of other people's money. Imagine buying a $1 million property, but you only invest $200,000. The remaining $800,000 comes from financing. Now imagine the property's value rises by 10%. Its value becomes $1.1 million. The gain is based on the value of the whole property, not just the cash you invested. Although borrowing also increases risk and costs. That's leverage. Banks make this possible because real estate is often accepted as collateral. Most businesses cannot easily borrow millions against future ideas. But real estate? Banks understand it. They finance it. And investors use that financing carefully to grow portfolios over time. This is exactly how many real estate empires began. Donald Bren purchased land and developed it into one of America's largest privately owned real estate portfolios. Sam Zell became known for buying undervalued commercial properties, improving them, and selling or holding them strategically. Many successful investors weren't building skyscrapers on day one. They bought one property, then another. They refinanced. They reinvested. They allowed appreciation and rental income to fund future purchases. It's a snowball, slow at first, then impossible to ignore. But there's one final ingredient that transforms wealth into something much bigger. Time. Level 5. The strategy that creates generational wealth. Here's the mistake many people make. They think wealth is about making money. It isn't. It's about keeping assets across generations. Look at many wealthy families. They don't sell valuable real estate every time prices rise. They hold it for decades, sometimes centuries. Why? Because every generation starts further ahead than the last. Parents buy property, children inherit it. Grandchildren inherit an even larger portfolio. Rental income grows. Loans get paid off. Property values often rise over long periods, though not in a straight line. Inflation increases rents over time in many markets. Meanwhile, the family owns more assets. This creates a cycle. Assets produce income. Income buys more assets. More assets produce even more income. The family becomes less dependent on wages. That's generational wealth. Think about families that purchased homes in major cities decades ago. Back then, the prices looked expensive. Today, those same properties may be worth many times more. Not because the owners were financial geniuses, but because they stayed invested. Patience became profit. This is why long-term investors often say time in the market matters more than timing the market. Of course, real estate isn't risk-free. Markets can fall. Interest rates can rise. Vacancies happen. Repairs can be expensive. Some locations decline instead of growing. That's why successful investors research carefully, keep financial reserves, diversify where appropriate, and avoid taking on more debt than they can comfortably manage. Real estate rewards discipline, not speculation. The biggest fortunes weren't usually built overnight. They were built brick by brick, property by property, generation by generation. Conclusion. Here's the truth. Real estate was never just about houses. It's about ownership. It's about controlling assets that people need. Places to live, places to work, places to shop, places to build businesses. While many people spend decades chasing higher salaries, some quietly spend those decades accumulating assets, and eventually, the assets begin earning more than their jobs ever could. That's the real estate strategy that has built fortunes for centuries. Not flipping houses for quick profits, not gambling on hot markets, but buying quality assets, holding them through economic cycles, using cash flow wisely, managing debt responsibly, taking advantage of long-term appreciation where it occurs, and passing those assets to the next generation. Because true wealth isn't measured by the size of your paycheck. It's measured by how many income-producing assets continue working when you stop. The wealthiest families understood this long before modern investing existed. The question is, will the next generation of wealth builders understand it too? Because the greatest real estate investment isn't always the one that makes you rich today. It's the one that keeps your family wealthy long after you're gone.